Bad news just hit. Tariffs aren't working, and Trump is now faced with a huge problem. The BEA just yesterday released trade data showing our current account hitting a record $150 billion per month deficit and a staggering 6% trade deficit relative to GDP. And it raises some crucial questions. Are tariffs really working? Is Trump's approach going to work? What does this spell for the future? And what does it spell for the dollar? We'll also uncover how the capital account surplus influences housing prices and housing affordability, contributes to wealth inequality, and drives corporate profits and the stock market. Stick around to the end for a look at how Trump may fix this and what it spells for the dollar, which I think the real point here is about the dollar, but it's important to first establish a couple definitions here. So here we have the current account. This is one of two main accounts that a country will have in international accounting. We run a current account deficit. We can see it's $450 billion per quarter. This particular BEA data release is quarterly, so $450 billion in a quarter is $150 billion per month. This is one of the two main accounts a country has. Think of it as two buckets. You fill up bucket A, and bucket B must be empty. So if we run a current account deficit to $450 billion a quarter, we must run a capital account. That other bucket must be filled with an equal amount of water, right? So if you take any water out of one, it must go into the other. This is just, a accounting reality. This is just how it works. Here I will show the balance of trade. Again, remember, this is one component of the current account. But what's really important here is the current account deficit as a share of GDP. And here we see that in blue. So it is a record 6% or very near a record 6% of GDP. Remember, the U.S. is a twin deficit. So we also, in addition to running a 6% current account deficit, we also run a 6.5% heading to 7% fiscal deficit. The fiscal deficit is the difference between what a country spends, what a government spends, and what it collects in tax revenue. So now that we have the definitions and some of the basics out of the way, let's get into the BEA release. I will include a link to this in the description. And here we can see that the current account deficit widened by $138 billion from last quarter. This represents a 44% increase in the trade deficit. And the revised fourth quarter deficit was $312 billion. This represents 6% of GDP. Meanwhile, the last quarter of the fourth quarter of last year was only 4.2% of GDP. This was mainly driven on an expanded deficit on goods. So here we can see the components of the current account, and I will show it a little bit bigger here. So I don't talk about secondary, primary income. You can see they're very minor contributors to the current account. The main thing here is services and goods. So people have pointed out a lot of times in my videos on international finance that we run a services surplus. Well, that is correct. It's about $70-80 billion. You can see that in the dark blue bar, but look at how big the goods deficit is. Now think of services as financial services, tech services. Think of goods as actual physical goods. And then finally, you take all of these colored bars into account: services, secondary income, goods, current account, and that's the current account. That orange line is kind of the final tally of any surplus that you have, and then any deficits in any of the others that you have. This is kind of the current account. This is one of those two main buckets. And we've established that it hit a record, whether you're measuring it as a share of GDP or certainly on a nominal basis. It is just, this chart is pretty crazy. But remember, the other side of this is a capital account surplus. And so we will get into that shortly. Here is a difference between our imports versus our exports. And we can see that exports of our goods and services have been increasing going back to 2020. That is good. The problem is that imports of goods and services have increased way faster than our exports have. This difference is what drives the current account deficit. Here, what I think is really interesting, and I'll get into the points about the dollar that we are going to get into next. If you look at the actual components of what is driving this, so let's look at goods. Exports of goods increased $21 billion to $539 billion for the quarter. Imports of goods, on the other hand, increased by $158 billion, right? So even though our exports increased a little bit, our imports increased way more, which is what we had just mentioned. The increase in exports was capital goods, mainly civilian aircraft and computer accessories, peripherals, and parts. This is why I think it's important to pay attention to these trade deals that Trump is talking about. One of the main components of it is purchase orders, locking in these foreign countries to buy our high ticket items from Boeing, say, right? An aircraft is a high ticket item and they have a dramatic effect, especially if it's done in size. But look at the increase in imports, right? We established imports was way higher, 158 billion versus our exports only increasing 21 billion. What was the increase in imports led by? It was led by non-monetary gold and consumer goods, mostly medicinal, dental, and pharmaceutical products. When they say mostly, what they were talking about is the consumer good portion. But look at this non-monetary gold. The increase in imports for the US was led by non-monetary gold. We'll get into this in a second, what it might represent. You can go through and read the services breakdown. It decreased slightly, but here's what really matters. So we had mentioned the other side of a current account deficit is this capital account surplus. Well, here in the BEA report, we can take a look at that. There were some issues with the wildfires that we see here. But here is the financial account or capital financial account. So here we can see on the left the net US acquisition of other people's stuff, right? This is us in the US buying the rest of the world's financial products. We'll now look on the other side. Here is their buying, right? The rest of the world buying US assets. Now, there's a couple different components. There's foreign direct investment, and you can see that that makes up a relatively small amount, especially for our liabilities. Portfolio investment is really the main one here. This is, one of the ways you balance a current account deficit. One is by this capital account. Well, where does all this money flow? Where does $450 billion per quarter flow into? Well, U.S. equities, right? The U.S. stock market, U.S. corporate bonds, U.S. treasuries, real estate, whether it's commercial real estate, single family homes, farmland, right, which is kind of being talked about a lot now. This is mainly because of our current account deficit. One of the reasons other countries don't allow foreigners to purchase farmland and real estate to the degree that the U.S. does is because they don't run a massive current account deficit, as we can see here. This must be balanced. Now, it's important to point out here, some people have argued that really, we talk about the twin deficit, talking about our current account here, but some people argue this is the chicken, and really what the egg is, the root of the problem, what comes first, the proximate cause, is a capital account surplus. I'm sympathetic to that view. I don't think we'll ever really know which causes which, but if you have a capital account surplus, just by definition, you will have a current account deficit. This is just how it works. So let's look at this. So that portfolio investment we mentioned, equities, bonds, real estate, right? And we can see U.S. net incurrence of liabilities. Remember, when a foreigner buys a treasury bond or a stock or a single family home, that is our liability, right? So we are incurring a liability to the rest of the world. When we buy their stuff, they are incurring a liability to us. This is that net international investment position that I've talked about so much that I think is super, super important, that shows that the U.S. isn't really a sovereign nation. Our net international investment position, that is the difference between what foreigners hold of our stuff versus what we hold of their stuff. That net international investment position, or NIP for short, is negative 100% of GDP. This I've looked and not been able to find another country in history where the NIP is that negative. Now, this is contrasted with countries like Taiwan, which has a massive positive net international investment position. I think it's like 180% positive of their GDP. And this is because they run a current account surplus. So they are able, right? The definition of that is they must accumulate savings, right, and have that positive net international investment position. So here goes through a breakdown. We can see derivatives, $19 billion. Remember, one of the industries that does really well with a hyper-financialized economy driven by globalization, driven by the dollar's reserve status, is finance and financial services. We can see they bought $19 billion of derivatives. And here is a breakdown of the various assets that were purchased and liabilities from us to the rest of the world. But again, I want to go back to that gold, that non-monetary gold. Here, remember, this was one of the drivers of our imports, which increased much faster than our exports. Remember that. So was driven by non-monetary gold. Well, what is non-monetary gold? Here is on the BEA's website. Non-monetary gold is used for two purposes: for industrial use, think jewelry, watches, electronics, and for investment as a store of wealth and a hedge against inflation. The BEA's national economic accounts, that is what we're looking at with the current account or the financial capital account, do not treat transactions in valuables such as non-monetary gold as investments, and therefore purchases of non-monetary gold as a form of investment are not included in PCE, gross private domestic investment, or government spending. Accordingly, NEA exports and imports of non-monetary gold should not include gold that is held for investment purposes. But the fact that, remember, you would hear non-monetary gold and think, oh, well, that's industrial gold. But as you can see by the BEA's own definition, they say, and for investment as a store of wealth and a hedge against inflation. So non-monetary gold, we've established by the BEA's own definition that yes, includes industrial use, but it also includes investment as a store of wealth or a hedge against inflation. Remember, gold is a centuries-long money, right? It has been money for centuries. And in fact, 1 ounce of gold, going back to the ancient Romans, back then it would buy you a nice suit, right? The kind of colloquialism, it'll always buy you a nice suit, 1 ounce of gold. Well, back then it was the togas, right? And 1 ounce of gold back then would buy you a nice toga. Well, today, 1 ounce of gold will buy you a nice suit. Gold is kind of the measuring stick, not on an hour-to-hour basis, not on a day-to-day basis, but on a year-to-year, decade-to-decade, century-to-century basis. Gold is the best benchmark for kind of monetary debasement. It goes up because it's scarce. The price will go up when currency is debased. So just real quick, I've gone through this many, many times, but here's that capital account. Remember, it is the inverse, the opposite, the mirror image of our current account. Here's the capital account in white. Well, here's the S&P 500 in red. We can see the correlation there. Here is the net worth of the top 1%, and we can see how well the current account deficit, the trade deficit, we can see how tight the correlation is. As our trade deficit widens, the net worth of the top 1% outpaces GDP. Remember, that is what this yellow line is showing. Net worth divided by GDP. So as this yellow line goes up, that means the net worth of the top 1% is increasing faster than our GDP is increasing. And we can see they do very well with a trade deficit. Well, we can get into the mechanics of that at a later time, why that is. But I want to point out one period of time, which we will also see with the housing. This period of time from 08, 09, all the way through to 2017, 2018, there's a divergence, of course. Most people have noticed that. Well, this was when the Fed was engaged in QE. We can see they took their balance sheet. This is printing money, right, to buy assets. They took their balance sheet from $900 billion all the way up to $4.5 trillion during that time period. This is what that range with the dotted lines, that is what that shows. We can see the net worth of the top 1%. They did very well during QE. Their net worth increased much faster than GDP, and it increased despite our trade deficit, our current account deficit, not really doing much, which I think is super important given that we're probably going to return to QE. Here is the corporate profits in blue. Again, multinational corporations are able to outsource jobs, pay much less in foreign countries, reap all the rewards. It's basically a huge arbitrage. It's a global arbitrage on labor. Well, the corporations benefit And of course, that drives the stock market higher, right? Like we saw with S&P 500, as corporate profit, as multinational corporations do better with an ever expanding trade deficit. That also drives the S&P 500 higher because, of course, the S&P 500 represents a claim on those corporate profits. Well, here is a single family home divided by the median family income in America. And we can see since kind of globalization and this really hyper financialized economy started in the 90s, we can see that it is almost a direct fit to the current account deficit, or put another way, to the capital account surplus. Now, there is, again, a divergence here, right, from 08, 09 through to 2017. Again, remember, this is when the Fed was taking their balance sheet higher by printing trillions of dollars to buy assets. One of the assets that they bought was mortgage-backed securities. Remember, if they still own $2 trillion of mortgage-backed securities, if they really wanted better affordability for tens of millions of young people that are struggling to afford to buy a house and engage in the American dream, if they really wanted to do that, they could sell those $2 trillion in mortgage-backed securities. That would take rates higher. That would drive down demand, drive down prices, right? No more bidding wars and utter insanity that we see in the housing market the past 5 years. Because look at what happened when they started engaging in quantitative tightening. Remember, here from 2018 in Trump's first administration, they did the opposite of printing money and buying assets. They did quantitative tightening. And this started in about early 2018. So let's look what happened in early 2018. Well, home prices, or the affordability relative to incomes, actually got better by a significant amount, right? So QE made it worse, obviously. Printing money to buy mortgage-backed securities is going to have a negative effect on housing affordability. But the opposite is also true, right? As soon as they started selling some of those mortgage-backed securities, the affordability of housing came back. Well, then we know what happened in 2020. We can see that affordability shot higher and is at record levels. So we mentioned the non-monetary gold. We established that this is not actually really non-monetary. There are two purposes, one of which is non-monetary, and the other is for investment as a store of wealth and a hedge against inflation. Why? What is going on here? So we are looking at the dollar here. A lot of people have talked about this 10% decline in the DXY. Remember, the DXY is just a measure of the dollar relative to other foreign currencies. It is not necessarily a representation of your purchasing power or inflation or anything like that. Remember, if we print, say, $10 trillion, but Europe prints $50 trillion, we are both debasing our currency, and the people will suffer through lower purchasing power, but the dollar will strengthen because we are printing less money. We are debasing to a lesser degree. So all the DXY is measuring is, some call the dollar the cleanest dirty shirt. It's a very, very, I think, apt comparison. And a lot of people have talked about this 10% decline over the past quarter or two. And for sure, it is notable. We've been talking about it pretty exhaustively. But what I want to go to here is what happened in 1980. So in 1980, we saw the dollar just absolutely skyrocket. From the summer of 1980, it was at 86, and it went as high as 160 in 1985. So just a couple of years, it was just meteoric. Well, what happened here at the top? We mentioned this in our dollar video, and I will link to that at the end. We mentioned it, but this was the Plaza Accord. This was a global monetary reordering where the U.S. got together with all these other countries and decided basically on what the new exchange rates would be. And sure enough, we saw a weakening of the dollar. Now, if people want me to do a video on that, please leave a comment. I've touched on it in a number of my videos, but if you want that, please leave a comment. In 1985, the dollar fell from 160 all the way in 1987. So just 2 years later, it had fallen 45%. 46% just in a matter of a couple years. This was the Plaza Accord. This is where I think we are heading. Now, remember, you look at where the dollar is now versus to then, and you go, well, but if we weaken the dollar that much, it'll be way too weak, right? It'll be too much of a weakening. Well, remember that on a purchasing power parity basis, the dollar is even more overvalued now at, call it 100, than it was in 1985 at 160. If you look on an interest rate differential basis, the dollar is still overvalued. If you look on a balance of payments basis, right, which is the current account, fiscal, all that kind of overview, the dollar is grossly overvalued. The dollar is grossly overvalued no matter how you look at it. So a return to fair value, right? If the dollar were to go to 60 or even below that, maybe in the 50s, while that would be significant, just like the Plaza Accord was significant, it would only be a return to fair value. The issue is that this overvaluation has just been getting worse and worse and worse. And I've showed many charts and many videos talking about this. But I think that the rest of the world is seeing, what is coming, right? Whether you look at Trump's executive order in February where he went after and targeted foreign capital, right? I think it was Chinese capital in that particular instance. Or if you look at the talks of foreign taxes, right, on foreign held U.S. assets, financial assets like U.S. Treasuries, starting to tax that again. All of these sort of things are efforts to drive down the capital account surplus, to get foreigners to buy less of our stuff. And remember, just as the capital account getting larger could theoretically be driving our current account to get worse, the opposite is also true. If we disincentivize foreigners from buying all of our financial assets and making our top 1% obscenely wealthy, if we discourage that, well, that'll have a positive impact on the current account. So it's important to mention that it goes both ways. And there have been a couple instances where I've thought to myself, well, it sure looks like they're running the Michael McNair, Stephen Miran playbook. Now, Michael McNair is a great follow on X. He focuses on this even more intently than I do. Great follow. I'd highly recommend him. Stephen Miran is the chairman of the Council of Economic Advisors. He wrote an entire paper on how to do this, by the way, how to kind of restructure, whether it's through tariffs, the dollar, a reordering with dollar, all these things. And I will link to that. I've read it multiple times. I think it's great, considering this guy is now the chairman of the Council of Economic Advisors. I will also point out Scott Bessent, the Treasury Secretary, in his speech at the Manhattan Institute in the summer of 24, way before he was Treasury Secretary. Trump hadn't even won the election, right? Before all that, he was out there talking at that speech. 3 times he mentioned the phrase global monetary reordering. And not only did he mention it 3 times, he said, and I want to be a part of it. Now, here we see the price of gold in US dollars. Remember, the other way to think about this is that this is what the dollar will purchase you in terms of gold. And sure enough, going back to 2023, the dollar will purchase you about 60% less gold than it did a couple years ago. So, you could look at that as a negative purchasing. The gold market is marking to market the fiscal reality of the United States and the fact that the dollar is grossly overvalued. I think that some degree, no one can say how much of this run up in gold is pricing in this reality, but certainly a substantial portion of this run up, this near doubling in the price of gold, some amount of this, huge meteoric rise is pricing in the fiscal reality. We did a video a couple days ago about Trump's comments cutting the overnight federal funds rate by 200 to 250 basis points, issuing all the debt at the short end, and basically just running the emerging market playbook until eventually long-term rates get so high that they have to QE, which will just make inflation even worse, right? We mentioned that seems to be what Trump wants to do with the fiscal and the debt and all that. We've mentioned the one big beautiful bill is going to increase the deficit. We've mentioned the fiscal deficit for fiscal year 25 is actually 12% higher than this time last year for fiscal year 24. Gold is pricing all this stuff in. Gold is pricing in that 20% of our tax receipts are going to interest, that our mandatory spending is over 100% of government revenue, of tax receipts. All of these issues, 125% debt to GDP, All of these issues, I think gold is pricing it in, is marking to market the fiscal reality of the United States, is how Luke Gromen puts it. And I agree 100% with that way of thinking about it. But we also know that US is importing huge amounts of gold. Well, why would they be doing that? Anyone in the know, if they knew that a Plaza Accord was coming, right, where we're going to repeat another monetary reordering to weaken the dollar, finally make US goods competitive on the global market, they would be buying gold. Now, that would drive the price of gold up, but that would also drive this not increase in imports of non monetary gold. So I think that all of this is really, really important. And I think that this huge increase in imports of gold, tied with the fact that the dollar is kind of grossly overvalued, no matter how you look at it, tied with the stated objectives of the chairman of the Council of Economic Advisors and the US Treasury Secretary and the president. I mean, we have the vice president talking in Congress, and you can find this clip on YouTube. He pressed Jerome Powell, the chairman of the central bank, on the downsides of the dollar being global reserve currency. That man, you never hear that talked about. Not in the past 5 decades would you hear a senator do that, talking about Triffin's dilemma and Dutch disease, concepts we are, near and dear to our heart. This is, I think, if this sort of thing is going to happen, I think it's going to happen during this administration. I think all of these signals are super, informative as to where we might be going. Now, how do you protect yourself in this world with a weaker dollar, a fairly valued dollar? Scarce assets, right? Gold has been money for centuries. Gold has been for centuries a measuring stick. We mentioned the 1 ounce will always buy you a nice suit, no matter if it's ancient Roman times or present day. Gold is the kind of measuring stick for currency debasement, and it's been there for thousands of years. Bitcoin, people claim, is digital gold, right? Is a much newer asset, but at its heart, it is trying to be a better version of gold, right? The inflation rate of Bitcoin is actually lower than gold, so it's actually more scarce than gold, and that scarcity is hard coded into the protocol. So everyone knows what the inflation rate will be today. They know what it'll be 4 years from now. They know what it'll be 10 years from now. And it's only going down, by the way. That inflation rate is ever decreasing in terms of new supply. So, scarce assets, scarce bearer assets, right, held in self-custody. You don't hold your gold at someone else's warehouse, right? You hold it in a safe in your house. That's the whole point of it. It's a bearer asset. You have sovereignty over your wealth. The same goes for Bitcoin. The point of it is not to hold it on an exchange. The point of it is to hold it cryptographically secure in self-custody. I understand people have issues with Bitcoin. I'm not here to try to change anyone's mind about that. Maybe we'll do a video on it later. I understand people have their hesitancies. That's okay. Gold has been proven for thousands of years to protect against this sort of event. Massive decrease in purchasing power, a weakening of the dollar relative to other fiat currencies as measured by the DXY, all of these things. So anyways, I hope that was helpful, and I will catch you in the next one.